This morning, February 28th, 2026, the United States and Israel launched what President Trump called major combat operations against Iran. Within hours, Iran retaliated, striking U.S. military bases in Bahrain, Qatar, Kuwait, the UAE, and Jordan, while also firing missiles toward Israel. Oil markets are bracing for significant volatility when they reopen Monday. Gold analysts expect prices to gap higher, potentially testing $5,300 per ounce. Silver surged 4.8% on Friday to over $92, and experts predict further gains as safe haven demand accelerates. The Strait of Hormuz, through which 20% of the world's oil flows, is now an active conflict zone. This isn't just a geopolitical event. This is an economic earthquake with direct implications for inflation, interest rates, precious metals, and your purchasing power. Hi, I'm Roxanne. Before we go further, let me be clear about what this channel does. I sell nothing. No courses, no memberships, no premium content behind paywalls. What you're about to see is analysis of how geopolitical events translate into economic outcomes, backed by market data, analyst forecasts, and verified sources. Over the next 20 minutes, we're going to walk through what happened overnight, how markets are likely to respond when trading resumes Monday, what this means for oil prices and inflation, why precious metals are surging, how the Federal Reserve is now trapped between conflicting pressures, and what individuals should understand about protecting purchasing power during periods of heightened uncertainty. Let me walk you through the sequence of events, because understanding the timeline is essential to understanding the market implications. Saturday morning, local time in the Middle East, the United States and Israel launched coordinated strikes against Iran. According to official statements, targets included military installations, missile facilities, and defense infrastructure across multiple Iranian cities, including Tehran, Isfahan, Qom, and Kermanshah. President Trump announced the operation in a video statement, describing it as aimed at eliminating imminent threats from the Iranian regime. Israeli Prime Minister Benjamin Netanyahu said the strikes were intended to remove an existential threat. Within hours, Iran responded. The Islamic Revolutionary Guard Corps confirmed strikes on U.S. military facilities in the region, including Al Udeid Air Base in Qatar, Al Salem Air Base in Kuwait, Al Dhafra Air Base in the UAE, and the headquarters of the U.S. Navy's Fifth Fleet in Bahrain. One civilian was killed in Abu Dhabi when missile debris fell in a residential area after interception. Explosions were heard across multiple Gulf capitals. Israel activated its air defense systems as incoming missiles were detected. This represents the most significant direct military exchange between the United States and Iran in modern history. It's not a proxy conflict. It's not indirect pressure. It's direct engagement across multiple theaters simultaneously. Now let's talk about why this matters economically, starting with oil. The Strait of Hormuz, the narrow waterway between Oman and Iran, handles approximately 20 million barrels of oil per day. That represents roughly 20 to 21% of global oil consumption. It's not just any 20%. It's the choke point that connects Persian Gulf producers to global markets. On Friday, before the strikes began, oil prices were already climbing. Brent crude rose to over $70 per barrel. WTI hit $66. Analysts from oilprice.com, CNBC, and energy market specialists all expect a significant war premium to be priced in when markets reopen Monday. The question isn't whether oil will rise. The question is how much and for how long. Estimates range from a 5% to 10% immediate spike, with potential for much larger moves if the conflict escalates or if Iran takes actions that directly threaten shipping lanes. Historical context matters here. When Israel and the United States conducted strikes on Iranian nuclear facilities in June 2025, oil prices jumped, but then moderated as the conflict remained contained. This time feels different because Iran's retaliation was immediate, widespread, and targeted multiple U.S. installations simultaneously. If oil sustains at $75 to $80 per barrel, that's manageable for the global economy. If it spikes to $100 or above due to sustained conflict or straight disruptions, you're looking at inflationary pressure that central banks cannot ignore. Here's where the economic implications become critical for everyday people. The Federal Reserve has been trying to manage inflation while supporting economic growth. As of last week, markets were pricing in 2 potential rate cuts in 2026. The 10-year Treasury yield had fallen to 4%. Real yields, the difference between Treasury yields and inflation expectations, had compressed from 1.98% to 1.72%. All of that was occurring in an environment where inflation seemed to be moderating and where the Fed had some flexibility. A sustained oil price spike changes everything. When crude oil rises by $20 or $30 per barrel and stays there, it flows through to gasoline prices, heating costs, transportation expenses, and the price of goods that depend on shipping and logistics. If gasoline prices in the United States rise from current levels around $3.50 per gallon toward $5 or $6 per gallon, which is entirely possible if oil hits $100 plus, consumer spending gets crushed. Discretionary income evaporates. Inflation expectations rise. The Federal Reserve then faces an impossible choice. Do they raise interest rates to combat inflation, potentially triggering a recession? Or do they keep rates low to support growth, allowing inflation to accelerate and eroding purchasing power? This is the definition of being trapped. And it's why precious metals, assets that don't pay interest but hold value during periods of monetary uncertainty, become attractive. Market analysts are unanimous in their expectations for Monday's opening. Gold and silver prices are forecast to gap significantly higher as safe haven demand accelerates. Gold closed Friday around $5,200 per ounce. Analysts quoted in multiple sources expect gold to test resistance at $5,300, with potential to climb toward $5,400 to $5,500 if conflict escalates. Some forecasts suggest domestic Indian gold prices could reach 168,000 to 170,000 rupees per 10 grams. Silver's move on Friday was even more dramatic. Spot silver surged 4.8%, topping $92.60 per ounce. That's a breakout above the $90 level that traders had been watching. Technical analysts are now targeting $95 to $100 in the near term if safe haven flows continue. Why are precious metals responding this way? Because they serve as stores of value during periods when confidence in paper currencies and government bonds wavers. When inflation threatens to erode purchasing power, when geopolitical instability creates uncertainty about future economic conditions, and when traditional safe assets like Treasury bonds offer negative real yields, investors rotate into hard assets. It's not speculation. It's a documented historical pattern that repeats across conflicts, currency crises, and periods of monetary instability. Silver's situation is unique because it operates in 2 markets simultaneously. As a precious metal, silver benefits from safe haven demand just like gold. But silver also has significant industrial applications: solar panels, electronics, electric vehicles, AI data centers. According to the Silver Institute, industrial demand accounts for roughly 50% of total silver consumption. This creates interesting dynamics. If the conflict remains contained and economic growth continues, industrial demand supports silver prices from below. If the conflict escalates and economic uncertainty rises, safe haven demand supports silver prices from above. Silver has already been in a structural supply deficit for 5 consecutive years. The Silver Institute projects 2026 will mark the 6th consecutive year where consumption exceeds production. The gap this year is estimated between 67 million ounces, Silver Institute, and 245 million ounces, JP Morgan, depending on assumptions about industrial demand growth. When you layer safe haven flows on top of an already tight physical market, you get the conditions for significant price moves. Friday's 4.8% surge is likely just the beginning if conflict persists. Now let me connect this to something we've been tracking closely on this channel: COMEX Silver Vaults. As of February 27th, yesterday, COMEX registered silver stood at approximately 86 million ounces. March 1st notice day saw 10,526 contracts standing for delivery, representing 52.6 million ounces. That's 61% of available registered inventory claimed on day 1. This is the context into which geopolitical safe haven demand is now flowing. The physical silver market was already under stress before this conflict began. Delivery rates in February approached 98%. London lease rates had spiked to 35%. Shanghai was trading at a $12 premium over Western spot prices. Now, add institutional and retail safe haven buying triggered by the largest U.S. military operation in the Middle East in decades. Where does that metal come from? The answer is, it comes from higher prices. When physical demand exceeds available supply, price is the mechanism that brings them back into balance. Either prices rise enough to incentivize holders to sell, or prices rise enough to reduce speculative demand. Or, in extreme cases, exchanges implement administrative measures like margin hikes or trading halts. We saw exactly this pattern in November 2025 when the CME halted silver trading for 10 hours, and again on February 25th when a 90-minute halt preceded a $6 price drop. Those interventions temporarily managed delivery pressure, but they didn't create new supply. When equity markets reopen Monday, analysts expect significant moves. Alicia Garcia Herrero, chief economist for Asia-Pacific at Natixis, forecasts global equities could open down 1% to 2% or more, with U.S. Treasury yields falling 5 to 10 basis points as investors seek safety. That's the immediate risk-off trade. But the second-order effects matter more. Energy stocks will likely rally on higher oil prices. Defense contractors may see buying interest. Technology stocks, particularly those with significant exposure to Middle Eastern markets or supply chains, could face pressure. The key variable is duration. If this conflict resolves quickly, within days or weeks, with minimal economic disruption, markets will likely recover most of their losses relatively fast. If this becomes a protracted engagement lasting months, with sustained oil price elevation and genuine risk to Gulf shipping, you're looking at a repricing of risk across all asset classes. Here's a detail that makes this particularly significant from a market psychology perspective. Hours before the strikes began, Oman's foreign minister, Oman has been mediating between the U.S. and Iran, told CBS News that a peace deal was within our reach. He described a breakthrough where Iran had agreed to never stockpile nuclear material that could be used for a bomb, with full verification by the International Atomic Energy Agency. If we just allow diplomacy the space it needs to get there, he said on Friday, a peace deal is within our reach. Less than 24 hours later, bombs were falling on Tehran. This matters because it signals to markets that diplomatic off-ramps, when they exist, can close rapidly. It creates uncertainty about the path forward. If a deal was genuinely close and strikes happened anyway, what does that say about the likelihood of de-escalation in the near term? Markets price probabilities. When the probability of sustained conflict rises, while the probability of quick diplomatic resolution falls, risk premiums expand across all affected assets. Beyond oil and precious metals, this conflict has implications for global supply chains that are already under stress. Qatar, UAE, Kuwait, Bahrain, these aren't just oil producers. They're major logistics hubs connecting Asia, Europe, and Africa. Dubai is one of the world's busiest cargo airports. Qatar hosts massive LNG export facilities. The entire region serves as a critical node in global trade. When missile alerts sound and airspace closes, which happened across multiple countries Saturday, cargo doesn't move. Flights get canceled. Ships reroute. The costs of insurance and logistics rise. Pakistan International Airlines suspended flights to the Middle East. Air France canceled flights to Tel Aviv, Beirut, Dubai, and Riyadh. Turkish Airlines canceled flights through March 2nd. Qatar Airways suspended all flights. Each of these disruptions has economic cost. Goods that don't arrive on time create inventory shortages. Businesses that depend on just-in-time logistics face production delays. The cumulative effect, if sustained, is inflationary pressure separate from the direct oil price impact. Let me shift to practical implications for individuals trying to protect their financial position. First, understand that inflation protection becomes more valuable during periods of geopolitical uncertainty. Assets that maintain purchasing power, precious metals, real assets, inflation-protected securities, become more important components of a diversified portfolio. Second, recognize that volatility creates both risk and opportunity. Markets that gap down on fear often present entry points for patient investors with longer time horizons. Markets that gap up on safe haven flows sometimes overshoot and create profitable exit points for tactical positions. Third, avoid panic. The worst financial decisions are made during moments of maximum emotional stress. Whether this conflict escalates or de-escalates in the coming days and weeks, knee-jerk reactions to headlines rarely produce good outcomes. Fourth, pay attention to oil prices and Treasury yields. These are the two key variables that will determine how broad markets respond. If oil stays below $80 and Treasury yields don't spike above 4.5%, the economic impact remains manageable. If oil pushes toward $100 and yields rise due to inflation concerns, you're in a different scenario. Fifth, remember that precious metals serve specific roles in portfolios. They're not growth assets, they're insurance. When the insurance is paying off, as it likely will in the near term, that's confirmation that the risks it was meant to protect against are materializing. Markets will be processing this conflict while also watching scheduled economic data. U.S. jobs data releases Friday, March 6th at 8:30 a.m. Eastern. The February Employment Situation Report will provide insight into labor market conditions. If the numbers come in strong, it complicates the Fed's position because it reduces the case for rate cuts, even as oil-driven inflation might be rising. If the numbers come in weak, it suggests the economy was already softening before this geopolitical shock hit. Oil inventories data from the U.S. Energy Information Administration will be watched closely. Any unexpected drawdowns would add to supply concerns. Builds might provide some relief. Statements from OPEC members, particularly Saudi Arabia and UAE, will matter. If Gulf producers indicate willingness to increase output to offset any Iranian production disruptions, that could cap oil price spikes. If they remain cautious or neutral, prices stay elevated. And obviously, developments on the ground in the Middle East. Ceasefire discussions, further escalation, involvement of additional parties. Each of these shifts the probability distribution of outcomes, and therefore market pricing. There is one recent historical comparison worth examining. In June 2025, the United States and Israel conducted strikes on Iranian nuclear facilities. Those strikes were significant. Intelligence suggested severe damage to Iran's nuclear program. Iran responded with a retaliatory strike on a U.S. airbase in Qatar that caused minor damage but no casualties. Oil prices jumped initially, then moderated as the situation stabilized. Equity markets sold off at the open, then recovered once it became clear the conflict wouldn't expand. The question now is whether February 2026 follows the same script. The initial strike is larger. The Iranian retaliation is more extensive. Multiple bases across multiple countries. The safe haven response in precious metals is more pronounced. This suggests markets are pricing a higher probability of escalation this time. That could be correct, or it could be an overreaction that creates opportunity as emotions settle. Here's what we know with high confidence. The United States and Israel conducted major military operations against Iran on Saturday, February 28th. Iran retaliated immediately against multiple U.S. military installations and fired missiles toward Israel. This represents direct military engagement between the United States and Iran at a scale not seen in modern times. Oil markets will price a significant war premium when trading resumes. Estimates suggest 5% to 10% immediate moves, with potential for more if conflict escalates or threatens Strait of Hormuz shipping lanes. Gold and silver are expected to gap higher Monday as safe haven demand accelerates. Gold analysts are targeting $5,300, with potential to test $5,500. Silver, which surged 4.8% Friday to over $92, may test $95 to $100 if flows continue. The Federal Reserve faces a policy dilemma. Rising oil prices create inflationary pressure at exactly the moment when economic growth may be softening. The choice between rate hikes to fight inflation and rate cuts to support growth becomes more difficult. Global equity markets will likely open lower, with volatility expected as investors process implications. Duration matters more than direction. Short conflicts resolve quickly in market terms, while extended engagements force repricing of risk across asset classes. For individuals, the practical message is, Geopolitical uncertainty reinforces the value of diversification, particularly into assets that protect purchasing power during inflationary periods. Precious metals, real assets, and inflation-protected securities serve specific roles that become more valuable when monetary and geopolitical stability are in question. Markets will tell us in the coming days and weeks whether this conflict escalates into a prolonged engagement or finds diplomatic resolution. In the meantime, understanding how these events translate into economic outcomes helps you make informed decisions about your financial position. This is not political commentary. This is economic analysis of how military conflict affects markets, inflation, interest rates, and purchasing power. If this analysis helped you understand what's happening and why it matters financially, share it with someone who needs this perspective. Drop a comment. Hit subscribe for updates as this situation develops. The markets will open Monday with significant moves already priced in. Understanding why those moves are happening and what they mean for your financial position is the difference between reacting emotionally and responding strategically. Stay informed, stay rational, and remember, uncertainty creates both risk and opportunity. Those who understand the difference can navigate periods like this more effectively than those who simply react to headlines.